Good morning, everybody. Today is Friday, July 1st, beginning of the third quarter. Happy 4th of July. We will not be having a show on Monday, the 4th of July, but we will be back here on Tuesday. We have a light cast today. Andrew and Tom and everybody's kind of out, but still here, still working. So first thing is on Q2 returns, the S&P 500 was down 16.1%, NASDAQ was down 22.3%, Dow Jones down 10.8%. Europe, if you look in US dollar terms, was down 13.6%. A lot of people might just talk about it in local currency and it was down 8%. But in US dollars, because the US dollar strengthened so much in the second quarter, it was actually down a lot worse. And similarly, the Russian stock market was down in local currency, but because the Russian ruble strengthened so much, it was actually up 22% in US dollar terms. So definitely a divergence there. Obviously, Russia, a big energy exporter, and was benefiting from that. On fixed income, the Barclays aggregate bond index was down a little less than 5%, and oil was up 5% for the quarter. In terms of data this morning, the Eurozone consumer price index came in higher than expectations, but that was driven by higher energy and food prices. The June headline came in at up 8.6%, so very similar to what we're seeing here in the United States. The estimate was 8.5%. It is an acceleration from May when you're up 8.1%. What's interesting is the core inflation is much lower in the Eurozone than it is in the US. So whereas the US is seeing headwinds, significant headwinds from oil and gas, that's magnified in the Eurozone where they're importing much more expensive gas than we have in the US. But the underlying core inflation in Eurozone is much less than we have in the US. That's only at 3.7% right now in the Eurozone and at 6% here in the US. So I would characterize this as much more severe inflation pressures in the United States than in the Eurozone on an underlying basis. However, you do have the gas prices that the Europeans just can't control. And in fact, they are going to a little bit, they're not calling it gas rationing, but that's essentially what is going to happen. The German government is now seeking the ability to create a tax that's going to be paid by all natural gas consumers. And this is a way to help suppliers who are facing rapidly rising import prices. So like your utilities, all these companies who were, paying that are a lot of times state run, they are now going to have basically a surcharge in Germany as a way to help them balance their budgets and make sure that they can stay solvent. And this is interesting because it's already happening. We're not even in the winter months yet, and you're already starting to have a gas tax on all natural gas consumers. So this goes for your industrial companies, this goes for your chemicals companies, and this of course goes for your consumers as well. And I think that this is going to be significant as we move through this year, because I don't know how much longer a lot of these Europeans are going to be able to take these higher gas prices and pay these higher bills and pay these taxes funding the war in Ukraine. In company news, and this is where I wanted to camp out a little bit more today, we have Kohl's, and we've talked a little bit about them trying to sell the business. They were going to sell it to the franchise group, but Kohl's is already a bigger company in terms of market cap than the franchise groups. They're really trying to line up the financing. Well, financing is extremely difficult to come by these days. So Kohl's had talked to more than 25 parties in a pretty exhaustive process. They finally picked the franchise group as a way to move forward. I think their bid was around $55 a share. At the time, Kohl's was trading at about 40. Well, that deal has fallen through. Kohl's is moving on for the deal. The franchise group just never was able to get anywhere close to getting the financing that it needed. However, the board is instituting an accelerated share repurchase program to the tune of $500 million. I am a little bit concerned that Kohl's is doing the right thing here. Obviously, they can't sell the business. No one really wants to buy the business. If they wanted to, they certainly have plenty of opportunity to. And so right now, Kohl's is in a little bit of a no man's land. They were really betting on being able to sell the company. That didn't work. and now they have to look back at their business and actually execute on that. And I mean, we've seen with Bed Bath & Beyond how difficult that business is right now. And stock's now 16% this morning to $31 a share. And I wouldn't be surprised if it goes lower, especially given the negatives that we're seeing on the demand environment. And so as we look at the negatives a little bit more, starting with Constellation Brands. Constellation Brands, the maker of Corona, Modelo, Pacifico, they reported earnings yesterday, and they were not good. Excuse me, they were good. There was a good report, but it was taken poorly by the market. They're saying that, quote, while consumers are reporting increasing concerns about the economy, these concerns have not yet translated into significant behavior change for beverage alcohol shoppers. So people are still buying beer, but we're starting to see cracks in the armor elsewhere in the economy and elsewhere in demand. And I think the big theme that we were talking about yesterday and the day before is that we are moving a little bit away from this stagflationary environment where inflation is the main issue. Inflation is going to be here and it's going to remain for a while. And part of that's due to shelter inflation and the high oil prices. That's just difficult to see that going away overnight. But we're starting to see some loosening in the pricing pressure. For example, the average price cut, 6.1% of homes, active listings have had price cuts in the last month. That's up from just 2% this time last year. So people are actually cutting prices on their homes that they have listed rather than necessarily these overbids for homes. And that's on a national basis. Obviously, there are pockets where the housing market is stronger, housing market's weaker. But this is where we might be starting to see some falling in terms of the inflationary pressures on the business. So we're moving from this environment where inflation is the real buzzword to recession is the real buzzword. And I think that's the significant takeaway from the earnings reports that we've been getting, even just over the last couple of days. Meta, formerly Facebook, Zuckerberg had a talk yesterday with employees, and it was leaked out to Reuters. And he said a couple quotes that are really significant that do not give me confidence about where the economy is going. He said, quote, "There are probably a bunch of people at the company who shouldn't be here. Part of my hope by raising expectations and having more aggressive goals and turning up the heat is that some of you might decide that this place isn't for you, and that self-selection is okay with me." So essentially, he's saying it's not me, it's you. You might want to move on as an employee. And then he further talks about the recession, saying, quote, "If I had to bet, I'd say that this might be one of the worst downturns that we've seen in recent history." So Zuckerberg talking a lot like Elon Musk in terms of really warning about how bad this recession could be. And it's something that we've really seen the epicenter be in California. In Silicon Valley, this is where a lot of the job pressures are coming. This is where a lot of the fast money was, and this is where a lot of the employees are being lost. And frankly, these are highly paid employees who have high standards of living, who consume a lot of services, who consume a lot of goods, and these people are going to lose their jobs. And so I think that's notable, and Zuckerberg really pulling back on the growth impetus is notable also. Micron, the memory chip manufacturer, again, we talked about moving from an environment from inflation to recession. This is exactly what I'm talking about. Average selling prices were actually down slightly across the business in both random access memory and NAND flash memory. And they said that near the end of the quarter, they, quote, "saw a significant reduction in near-term industry demand, primarily attributable to end demand weakness in consumer markets, including PC and smartphone." They went on to talk about the PC outlook. They say that it's now looking for a deterioration of 10% for the full year. That's down from a forecast of just flat. And then mobile, on that side, they say that smartphone unit expectations have declined, quote, "meaningfully," and they're now projecting a decline of around 5%. They were expecting it to be up 5%. So we're seeing about 10% reductions in consumer electronics. They did say that the auto business is strong, the industrial business is strong. Basically, when they sell to B2B, they're actually doing okay, but they're going to take immediate action to reduce the supply growth trajectory as a result. So we've moved in the space of about 10 weeks, we've moved from an environment where we couldn't get chips at all to we have too many chips, and Micron is immediately moving to address those inventory concerns. That's how quickly things have turned. There was a report out of Digitimes as well that Taiwan Semiconductor is seeing clients scale back orders, especially AMD and NVIDIA. Apple also has cut its orders by about 10%. NVIDIA is facing a problem of oversaturated gaming chips. Part of that's due to the decline in Bitcoin, where Bitcoin mining was facilitated by those gaming chips and those graphic processing units. So Micron telling a pretty dour story about consumer electronics and the consumer in general. Clearly, things have shifted pretty significantly there. Kohl's was also talking about this, saying they're seeing a softening in consumer spending. They now expect sales to be down in the high single digits for the second quarter. They previously were expecting to be down about 1% to 2%. Now you're talking about 8 or 9%. So things are not in a great spot here. And that kind of goes across the board, especially led by the consumer. The consumer is not strong. And where does that leave us? Well, we're trying to emphasize businesses where we have less consumer exposure. We'll have some more information on that in the market memo that we'll have out this afternoon. But we're moving away from companies that sell to regular consumers, that market to consumers, and we're moving toward business to business companies as we try to navigate this environment. So that's where we stand. I know it's not the July 4th message you want to hear, but it's what we're dealing with right now, and we have to deal with the hand we're dealt. So that's where we're going. There won't be a show on Monday. Enjoy your July 4th. We will be back here on Tuesday to digest the ISM manufacturing report that comes out later today, as well as preview the jobs report that'll come out next Friday. I hope you have a great weekend. Enjoy your time with family, enjoy your time with friends. Hopefully the weather holds off and you can get out for a barbecue. But with that, have a great rest of the day, and happy July 4th, everybody. Bye-bye.